everyone. Today we're talking about the District of Columbia corporate income tax apportionment, that is, um, tra- transition from Joyce to uh, Finnigan method. Let's continue. The District of Columbia, DC, has enacted significant legislation that will change how uh, multi-state corporations apportion their income for DC corporate income tax purposes. Beginning in 2026, DC will transition from the Joyce method to the Finnegan method of apportionment for unitary combat groups, with important implications for business operating in the district. Let's see the legal framework. The first is key changes. The new provision replaces the previous language, which followed the Joyce method. The key changes are the combined group is now treated as a single taxpayer for sourcing represents. Sales from all members are included in the numerator regardless of individual nu- nucleus, and this applies specifically to unitary combat groups. The second is relevant legislation. DC Code 4711810.02 D2, effective January the 1st, 2026, for purpose of calculating the sales factor under subsection of this section. A unitary combat group shall determine district sales by using the total sales of all members of the unitary combat group, including the sales of members that do not have nucleus with the district. Let's give a policy analysis. The first is demonstration relocation. At its core, this change simplifies that the complex issue of appointment to a single question: should sales be included based on the group's overall presence or individual entity nucleus? By focusing on this key aspect, we can better understand the applications. And second, let's give a modern construction. A simple model demonstrates how the Finnegan method can increase tax liability for some groups. Under the Joyce method, the DC sales factor would be 10%, but under the Finnegan method, it would be 15% due to the inclusion of sales from all members of the unitary combat group. And let's give another hand innovative thinking. While the changes appear straightforward, it's important to consider potential unintended consequences, such as incentivizing companies to restructure their operations to minimize DC sales across all entities, or leading to increased complexity in determining which entities are part of the unitary group. Let's give a case study, Tech Corp, and let's see three different conditions that are related to these changes. The first is Tech Corp DC. Tech Corp DC operations include a sales office which has a clean nucleus with the district. And the second is Tech Corp Cloud Services. Tech Corp Cloud Services has no physical presence in DC, but services some DC customers. And the third is Tech Corp R&D. Tech Corp R&D facility has no activity in DC. And under the current Joyce method, only Tech Corp DC sales are included in the numerator of the sales factor. However, starting in 2026, under the Finnigan method, sales from Tech Hub Cloud Services to DC customers will also be included, potentially increasing Tech Hub's DC tax liability. To adapt, Tech Hub might consider restructure increasing physical presence in DC or reviewing pricing and customers agreement and potential impacts. The first is increased tax liability, and the second is restructuring activities, and the third is adapting challenges, and the fourth is economic development impacts and preparing for the change. That is very important. First is analyze impact. Business should closely examine their structures and sales patterns to understand the potential impacts of the Finnigan method on their DC tax liability. A second is restructure operations. Companies may need to consider restructuring their operations, such as separating non-unitary businesses to minimize the tax burden under the new apportionment method. The third is reviewing pricing and agreement. Business should review their pricing and customer agreements to accurately determine their DC sales and the resulting tax implications. And the fourth is state informed. Tax professionals and business should stay informed about the implementations of the Finnigan method and any further developments in DC's corporate income tax policies and potential change and considerations. The first is uniform apportionment. The transition to the Finnigan method in DC could lead other jurisdictions to follow suit, potentially resulting in more uniform apportionment method across states. The second is digital economy challenges. Enforcing the Finnigan method may pose unique challenges for business in the digital economy, where sales can be difficult to attribute to specific locations. The third is economic development implications. The increased tax burden from the Finnigan method could have implications for DC's income economic development initiatives, as it may affect business investment and growth in the district. Let's give a conclusion. The transitions from the Joyce to the Finnigan method for corporate income apportionment in DC represents a significant shift in tax policy. While it is simply a certain aspect of compliance, it also has the potential to increase tax liabilities for many multi-state businesses operating in the district. As we approach 2026, business and tax professionals must be prepared to navigate the challenges and opportunities presented by this change in apportionment methodology. That's all. Thank you.